Have you ever heard someone say they bought a bond at a premium and wondered what that means? If so, don't worry. It sounds complicated, but the idea is actually quite simple. Let's start with a quick reminder of what a bond is. A bond is essentially a loan. When you buy a bond, you are lending money to a government or company in exchange for regular interest payments and the return of your principal at maturity. When a bond is first issued, it is usually sold at its face value. For example, a bond may have a face value of 100,000 Kenyan shillings. This means the government promises to return 100,000 Kenyan shillings when the bond matures. However, once the bond starts trading in the secondary market, its price can change. Just like land, shares, or any other asset, a bond's value can go up or down depending on demand. This is where the concept of a premium comes in. A bond is said to be trading at a premium when investors are willing to pay more than its face value. For example, suppose a bond has a face value of 100,000 Kenyan shillings and pays an attractive interest rate of 15%. A few years later, newly issued bonds are only paying 10%. Which bond do you think investors would prefer? Most investors would prefer the bond paying 15%. Because of this higher income, investors may be willing to pay more than 100,000 Kenyan shillings to own it. Perhaps 110,000 Kenyan shillings. That extra 10,000 Kenyan shillings is known as the premium. In simple terms, the premium is the additional amount investors pay to access a bond that offers more attractive interest payments than what is currently available. Think of it like renting a shop in a prime location. If one shop generates more business than others nearby, people may be willing to pay extra to acquire it. The same principle applies to bonds. Now you may be wondering, why would anyone pay more than 100,000 Kenyan shillings if they'll only receive 100,000 Kenyan shillings back? The answer lies in the higher interest payments. The investor is paying more today because they expect to receive stronger income over its remaining life. Over time, that higher income helps compensate for the premium paid. This is also why investors should never look only at the coupon rate. A bond paying a high coupon may look attractive, but if it is trading at a significant premium, the actual return may be lower than expected. Experienced investors consider both the price and the income. The opposite can also happen, known as trading at a discount. But whether a bond trades at a premium or a discount, the key lesson is this: the value of a bond changes based on market conditions, demand, and interest rates. Understanding premiums helps you make better decisions. In investing, what you pay for an asset is just as important as what it pays you in return. The more you understand, the more confident you become. Get in touch with Private Wealth today to learn more. Email info@privatewealth.co.ke or find us on Facebook, Instagram, TikTok, and YouTube at Private Wealth Capital, or call us at 0791796851.